Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about HEICO CORP Annual Report. HEICO Corporation offers a diverse range of products and services across various industries. Some of the key businesses and services provided by the company include aerospace and defense products, jet engine and aircraft component replacement parts repair and overhaul services for jet engines and aircraft components, avionics, instruments, composites, and commercial aircraft surfaces repair and overhaul electro-optical infrared simulation and test equipment, power electronics and power conversion products, interconnection devices, and molded cable assemblies, RF and microwave products, communications, and electronic intercept receivers and tuners, active antenna systems, and airborne antennas, nuclear radiation, detectors, ceramic to metal feed-throughs, and connectors. These services cater to various markets, including commercial, regional, and general aviation, as well as military aircraft. HEICO Corp's stock price has experienced a significant increase of over 40.51% in the past year due to several key factors. The company's consistently strong financial results, including record net income increases and robust demand across its business segments, have driven growth. Strategic acquisitions, such as Gables Engineering and electric power generation component repair companies, have also contributed to HEICO's expansion and increased profitability. Improved operational efficiency and a 9% dividend increase in June 2025 further boosted investor confidence. Overall, these positive news events have led to a surge in HEICO Corp's stock price. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth drivers. The company's revenue has grown due to a combination of factors. Key drivers include increased demand from the Flight Support Group, FSG, expansion into new markets and industries, development of proprietary technology, broadened product offerings, expanded customer base, and disciplined acquisition strategy. Additionally, organic growth through new products, services, and technologies, as well as expansion into niche segments, have contributed to revenue growth. Revenue decline drivers. On the other hand, revenue decline can be attributed to a decrease in net sales to external customers, particularly from FSG and ETG. The company has also experienced a decline in net sales in certain regions, including the United States of America and other countries. These factors have contributed to a total net sales decline of 16.1% in 2025 compared to 2024 and 51.8% compared to 2023. Net income and profit margins. A changing landscape. The net income of the company underwent significant changes between 2023 and 2025. Initially, it increased by $186,468, 33%, from 2023 to 2024, primarily due to the acquisition of Wenker and the inclusion of Exxelia's operating results. This trend continued with a further increase of 32% from 2024 to 2025. Profit margins also experienced fluctuations during this period. The operating margin decreased from 22.7% in 2023 to 21.4% in 2024, but rebounded to 23.1% in 2025. Conversely, the net income margin increased significantly, rising from 9% in 2023 to 13.3% in 2024, and further to 23.2% in 2025. Segment-wise analysis reveals that FSG's operating income margin improved from 21.9% in 2023 to 24.1% in 2025, while ETG's operating income margin decreased initially but increased to 23% in 2025. The effective tax rate also decreased from 17.5% in 2024 to 16.6% in 2025. Overall, the company's net income and profit margins have undergone substantial changes due to various factors such as acquisitions and operating results. The company's financial performance indicates a mixed record of generating positive operating cash flow. In 2 consecutive years, fiscal 2024 and 2023, the company reported positive operating cash flow. However, in fiscal 2025, it experienced a negative operating cash flow. This inconsistency suggests that the company's ability to generate cash from its core operations is not consistent across all periods. The company's financial health has shown significant improvement over the past year, with notable reductions in debt and interest expenses. Specifically, total debt decreased by $60 million from $2.23 billion in 2024 to $2.17 billion in 2025, while interest expenses dropped by $19.4 million, from $149.3 million to $129.9 million. Additionally, the interest rate on the revolving credit facility has been reduced from 6.3% to 5.3%. These changes indicate a positive trend for the company's financial stability and efficiency. Management is optimistic about the company's outlook, citing an impressive 18% compound annual growth rate over the past 35 years. They attribute this success to a combination of organic growth and strategic acquisitions that have broadened product offerings, expanded customer base, and increased geographic presence. Key drivers of their growth strategy include continued design and development of replacement parts, increased research and development activities, and direct relationships with customers. Management believes they are uniquely positioned to increase market share due to competitive pricing, reputation for quality, and strong relationships with commercial air carriers. The company will continue to invest in capital expenditures, with approximately $80–90 million anticipated in fiscal 2026. They expect to deliver strong operating performance, generate significant free cash flow, and maintain a robust acquisition strategy that drives growth and profitability. Overall, management is confident in the company's ability to sustain its growth trajectory and remain competitive in the market. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. Specifically, it has paid semi-annual cash dividends, with the most recent payment totaling $32 million in fiscal 2025. Additionally, the company has redeemed an aggregate of 76,492 shares in fiscal 2025, indicating a commitment to returning value to its investors through share buybacks. Concerns about inventory buildup and supply chain disruption are prevalent in the financial summary. Several factors contribute to these issues, including suppliers' inability to adjust delivery of long lead time products, external events such as tariffs and trade policy changes, geopolitical unrest, war, terrorism, transportation delays, and health emergencies. Inventory buildup is a significant concern, with an increase in consolidated backlog leading to a $132.9 million increase in inventories. Finished goods inventory for certain business units is also at risk due to changes in demand and sales patterns. High contract liabilities and large remaining performance obligations further indicate potential supply chain disruptions if not met. These concerns suggest that the company may face challenges in managing its inventory and supply chain, which could impact its operations and financial performance. That concludes the financial summary for HEICO CORP. Feel free to comment below, and I will be happy to answer them when possible.